Good morning and welcome this morning to Introduction to Cryptocurrencies, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I am joined this morning by my good friend and partner in this particular webcast series, Jim Ferrioli, who is the director of cryptocurrency trading and strategy at Charles Schwab. We're going to meet Jim a little more extensively as we get into this discussion, but I'm glad to have him here with us every Monday as we talk about these ideas. So thanks for being with us, Jim. We're also joined out there in the chat by my good friend Kevin Horner, who's a 20 plus year veteran, actually going on like 30, maybe even 40 years veteran of the financial markets. It keeps going up every time I talk to him, but he's a great resource there. He's going to be there to help answer your questions as those come in. So if you're here with us live, welcome. Ask your questions in the chat. If you're here in the recorded version, welcome to you as well. Ask your questions in the comment section for this webcast. So we're going to talk a little bit about today the topic of gaining exposure to cryptocurrency. We've talked a little bit about what is cryptocurrency. We've talked last week about how cryptocurrency works. Today we're going to introduce the idea a little more in depth of how a trader or an investor can gain cryptocurrency exposure in a portfolio and why they may want to have cryptocurrency or not want to have cryptocurrency exposure in a portfolio. And then next week in session 4, we're going to talk a little bit more in depth about the idea of what drives cryptocurrency prices, which is an interesting conversation, and it is one that is perhaps a little bit surprising for some traders, but we're going to get into that discussion next week as well. But a couple of quick reminders as we get into some of the housekeeping items that we need to pay attention to when it comes to this material in this discussion. First of all, remember that everything we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation or advice or solicitation of a particular security or strategy or anything else. Individual symbols, individual tools that we will use are simply for illustrative and educational purposes only. We're going to use some technical analysis in this discussion as well. Schwab doesn't recommend these technical analysis as sole means of investment research. Past performance, no guarantee future results. Now, a couple of very specific housekeeping items when it comes to cryptocurrency. Digital currencies such as Bitcoin, highly volatile, not backed by any central bank or government. They lack many of the regulations and consumer protections so far that legal tender currencies and regulated securities have. The risks associated with these products, cryptocurrency-related products, carry a substantial level of risk. They're not suitable for all investors. And the risks associated with these products are not fully developed. They are emerging and changing and dynamic. So they may be subject to extreme price volatility, liquidity, increased risk of loss. Make sure that you understand the characteristics and risks of these products to the best of your understanding before considering any of those transactions. Again, as we talk about this, we'll try to discuss any of those risks as we talk about them, but this is by no means an exhaustive list of the potential challenges and considerations for trading a product or investing in a product like cryptocurrency. Because it is new and developing. We're going to be using the Thinkorswim desktop software platform, specifically the paper money platform. It's not a guarantee of future success. It's a great learning environment. However, it does not do certain things that a live trading account will do. We'll talk about those as we get into this discussion. So if you're going to trade things like virtual currency futures, make sure you read the NFA Investor Advisory and the CFTC Customer Advisory regarding those particular products. So as we get into this, Jim, I'm going to bring Jim in here to the discussion. What we've talked about so far, as I mentioned before, what is cryptocurrency? How does cryptocurrency work? How do people get exposure to cryptocurrency? And what drives cryptocurrency prices? And so, Jim, we're really now on this one, number 3, which is the idea of how do people get exposure to cryptocurrency? So talk to us a little bit about the idea of what that means in terms of gaining exposure to cryptocurrency. Does that just mean holding cryptocurrency spot, meaning holding Bitcoins or Ethereum or something else in a portfolio or in a wallet? or does it mean something larger, perhaps?
Hey Ben, happy Monday.
Yeah.
Yeah, so there's a very narrow kind of definition of holding cryptocurrency, which would be holding the actual spot cryptocurrencies, right? Self-custodying. That's like the very crypto native approach. But for most investors who necessarily aren't that concerned with, kind of the equivalent of storing gold under their mattress. There's lots of other ways to have crypto exposure. That can be through futures, that can be through investment products, such as exchange traded products that hold and custody cryptocurrencies on your behalf. And that can also be through equities, stocks that either have some crypto exposure on their balance sheet are somehow related or involved in the broader crypto industry, or some stocks that really only exist to acquire cryptocurrency. So there's different ways that you can get them, and there's kind of different reasons why you might want some exposures versus others.
Yep. So, we talk about some of these things. We talk about the idea of how do we get exposure to cryptocurrencies, but maybe we need to take kind of a half step back and kind of walk through some of these other scenarios because there is kind of a more direct way that some investors actually acquire cryptocurrency. One of those direct ways is by actually creating it or mining it, right?
Correct. Yes, you don't need to buy if you want exposure to Bitcoin or any other proof of work blockchain. You don't need to buy the cryptocurrency. You can theoretically earn it. Validators on the Bitcoin blockchain are referred to as miners, and so you would need to use specific computer equipment so that you could participate in the validation of the Bitcoin blockchain. If you do participate in that, and often people will pledge their computing resources if they're a smaller or individual miner to a broader mining pool. You can then receive that your prospective share of any Bitcoin that is produced on their behalf. So that's one way to do it. If you already own something like Ether for the Ethereum blockchain, you can stake your Ether. Again, so this is the process where you would validate transactions on that blockchain. And the reward for staking your Ether is more Ether, similar to when a stock pays a stock dividend. Obviously, these are not equities. But again, so you can earn cryptocurrencies without actually buying them. So it's important to point that out. You can also accept them as a payment. The Bitcoin blockchain was initially created as a decentralized payments network with its own native currency. And so again, any cryptocurrency can be used as payment. If you're working with a merchant, or maybe you're a small business owner and you want to accept Bitcoin or cryptocurrencies as payment, you can receive them that way as well. And so there are different ways of just acquiring them as financial assets. And these are kind of the bigger and most common ways that people receive them.
Yeah, it almost seems though, and I think this is the method of kind of accepting as payment or mining on the casual basis, right? Because it is power intensive, as we talked about last week. But there are some novelty ways in which typical retail investors can mine, right? Those lottery miner type blocks that people can plug in and theoretically, potentially resolve a blockchain block and get rewarded with a Bitcoin. Novelty in the sense of accepting payment, because while that was, I think, initially the dream of Bitcoin to be this decentralized finance payment process, the reality of the situation is a little bit different. We don't oftentimes see, at least not from a casual basis, um, typical, people just walking down the street exchanging Bitcoin as payment for, or even other things like Ethereum as payment for goods and services, right? That it tends to be more of the novelty, right?
Yeah, it's primarily the use of these has really been investment focused. I mean, Ether as it's set as a current, Ether is really more of a currency.
Yep.
That's how it acts. You need it to interact with the platform, but most people primarily use Bitcoin as an investment, a store of value. If it's something that you're actively looking to swap out of your dollars and into Bitcoin, you're less likely then to want to trade that Bitcoin away for some service or product. But there are use cases. There are some large fast food chains that have had some success by accepting Bitcoin. There's point of sale retail sales
Mhm.
terminals that, again, they can accept Bitcoin, so the infrastructure is already there. But yeah, most people, again, are primarily using Bitcoin and different cryptocurrencies as financial assets, or to interact with their underlying blockchain ecosystems, as opposed to just everyday um, trade and point of sale.
I suppose the analogy would be similar, Jim, is to maybe having a safe in your home where you held physical gold bullion, and theoretically you could shave off shavings off of gold Krugerrands or whatever you might hold in your safe and exchange those, but that's not going to be the default. The default is you hold it in the vault and it either appreciates or depreciates in price based on exogenous forces. Same thing with Bitcoin. You hold those Bitcoin in a wallet, cold, warm, or otherwise. And rather than exchanging those fractions of Bitcoins for goods and services, you hold them as that appreciating or depreciating financial asset, correct?
100%. And to make it clear, this is very much from our US perspective. The US financial system is very efficient. It works. And so, again, it goes back to the idea that most people in this system tend to use Bitcoin as a means of investment and savings. If you're in a smaller developing country, the notion that you can have an alternative currency for trade that you can also then store, and it will hold its value over time, maybe better than your local currency, that may be more of a use case in that scenario. But again, from our perspective, where we see, our investors are primarily US, Western based, efficient financial markets, and using Bitcoin and cryptocurrencies for everyday transactions isn't really the main use case.
All right, cool. So let's kind of move now on to this idea again of kind of expanding beyond this is a digital currency that we use to facilitate transactions, to accumulating it as or decumulating it as a financial asset that appreciates or depreciates based on those exogenous forces that we talked about. So several ways that we can do that: buying and selling spot crypto, trading cryptocurrency futures is an example of a derivative trade of Bitcoin, for instance, or trading and investing in exchange traded products, or as you said, individual equities that maybe are uh, for purposeful reasons, holding Bitcoin, or it's part of their business model. Now, one thing have to say one thing real quick here, Jim, in terms of disclaimers regarding exchange traded products. We're not going to talk about specific exchange traded product symbols in this discussion, for the simple purpose that that would require us to go through some pretty significant regulatory hoops to record and archive this video. So we are not going to do that. So just keep in mind, we will talk about those, and we do talk about those in some of our other webcasts where we focus on exchange traded products. If you're going to trade ETFs, make sure you understand the characteristics, risk, charges, and expenses of those products. And by all means, read the prospectus. All right, off my soapbox. Now, Jim, let's talk a little bit about this idea of gaining exposure through these other means, including, and we'll go out to the Thinkorswim platform here in just a second, but let's talk a little bit before we do that about some of these companies that have cryptocurrency exposure.
Yeah. So lots of different types of crypto stocks exist. Very prevalent and in the news these past couple weeks. Strategy, ticker MSTR. And again, none of these are recommendations. They shouldn't be perceived as recommendations. But they're what's referred to as a digital asset treasury stock company. And so what they do is they have a legacy software business, but it's very small relative to their broader business. And what they do is they acquire cryptocurrencies on their balance sheet. So in this example, Strategy, they acquire Bitcoin. They have several different ways to do this. Some issue preferred securities, some use issuances of common stock. but ultimately they exist to acquire uh, cryptocurrencies. And so they're making the bet that using this treasury strategy, as Bitcoin appreciates, their underlying asset value appreciates, and therefore their equity value should also appreciate. Coinbase Global. Coinbase is the largest US crypto exchange. So, this is an example of a company that operates in the crypto industry, but it produces US dollar profits and sales. And so, Coinbase provides different services, but primarily is an exchange where their clients can buy and sell different cryptocurrencies. And so, again, it's a way to have crypto exposure. They do have some assets on held because they are a crypto exchange, but they're not there to make a bet on the direction of cryptocurrencies. You have companies like Mara Holdings. Mara is the largest publicly traded Bitcoin miner. So again, this is a company that operates in the crypto industry. Miners are participants of the Bitcoin network that secure the network and approve transactions, and they're rewarded Bitcoin for doing this. And so Mara is one of the largest corporate holders of Bitcoin because through their business operations, they are rewarded Bitcoin. And so they will store Bitcoin on their balance sheet. So similar to Strategy, they benefit as the price of those holdings appreciate, their net asset value appreciates, and the total value of the company appreciates. But at the same time, when prices are falling, they can also come under pressure. Now, companies like Mara Holdings, they want to generate a US dollar profit. And so they also have to time sales of Bitcoin because they have to upgrade their equipment every 4 years. They have CapEx costs, they have operating costs as well. And so they have to balance the accumulation with the selling to still manage their day-to-day operations. And then you have companies like Galaxy Digital. Galaxy Digital is a financial institution that's focused on digital assets, trading, and asset management. So again, it's a company that operates within the broader digital asset industry. It's not specifically acquiring Bitcoin or cryptocurrencies on its balance sheet to see its value grow from there, but as there's activity that they do interact with on behalf of their clients, right? They're generating US dollar revenue, US dollar profits. And so as you see more activity within the crypto industry and the clients that they serve, it would benefit them. It's important to point out, while all four of these companies do something different, they are highly sensitive to the price of Bitcoin. A lot of the time, crypto stocks really trade like more volatile Bitcoin proxies. And so understanding how much beta they have to Bitcoin is important. One of the big things that a lot of crypto stocks, not the digital asset treasury companies, but companies like Coinbase and Galaxy have been doing is trying to offer products that actually reduce some of this exposure to Bitcoin's price sensitivities. And so they can still, they're still crypto companies, but they aren't really over time seen as just kind of levered Bitcoin proxies. It's still a bit early and they still are very sensitive, but that's something to consider is when you're investing in a company, what do they think a future state is going to be where maybe they have different products that make them less cyclical to Bitcoin?
So, in terms of what we would maybe refer to as something like a pure play on cryptocurrency, for instance, Strategy would be considered perhaps a pure play on Bitcoin, for instance, because that is what they do. They acquire and they hold Bitcoin. So it has the most direct impact. Whereas something like Galaxy, which has other business products, uh, and other inputs, other revenue streams, they're maybe a little bit less sensitive, so lower beta relative to Bitcoin itself, correct?
In theory, that's where they're going. Galaxy's now involved in AI data centers, right? And so that's the idea over time. In the short term, that they still tend to be more kind of volatile Bitcoin proxies, though. They haven't really established enough of a clean break. A lot of their revenue is still inherently tied to the broader crypto market.
Sure. And then we've got another category of companies that have cryptocurrency exposure, but it is not necessarily their primary raison d'etre of being in business, for instance.
Exactly. So companies like Tesla, they hold Bitcoin on their balance sheet. Their business model has nothing to do with Bitcoin. And so again, in periods where Bitcoin's price rises, that can be beneficial to them because it marks the value of their assets higher. But again, in down markets, it marks them lower. So it can have an impact there. And Tesla has exhibited correlation to Bitcoin in the past. It's a risk asset. It's a tech stock. At time, Bitcoin has been correlated to risk assets and tech stocks. Block, they are a payments platform. They hold Bitcoin on their balance sheet. They also produce some infrastructure related to producing Bitcoin. And they also have point of sale equipment that they sell that enables customers to transact in Bitcoin. And so again, they're beyond just having some direct exposure, a lot of the times that they can be seen as a Bitcoin proxy. Again, they have a core business that's not directly related to Bitcoin. They're really a payments company, but they do have that exposure. PayPal as well. You can buy, hold, and sell crypto on the PayPal platform. They also have their own PayPal stablecoin. So again, their core product is not necessarily crypto, but they do have that exposure. And then, excuse me, NVIDIA produces GPUs. Back early days of Bitcoin, you could actually mine Bitcoin with NVIDIA GPUs, and it's very commonly still referred to as a crypto stock. That you can't actually mine Bitcoin with NVIDIA chips anymore. However, it's often exhibited correlation to Bitcoin and different cryptocurrencies. And so again, in the short term, if it's correlated to crypto, it has that history. And so people will sometimes still think of it as a crypto stock.
So one of the other things I wanted to ask, and I'm going to switch over here to the Thinkorswim platform while I'm doing this, Jim, is, much like, because we use this analogy, and I think it's an apt analogy of, mining for gold, right? And you think about what that takes, and that takes picks and shovels and, big industrial mining equipment. And you think about the relationship to mining Bitcoin or acquiring Bitcoin through that method, through proof of work or even through proof of stake, there is some kind of infrastructure element to it. The halo around cryptocurrency in terms of the infrastructure is another way that investors could gain exposure to cryptocurrency influences, correct?
Correct, exactly. If you have exposure to companies in that supply chain, it gives you exposure. And I see on the list here, we've got Bitdeer. Bitdeer is one of the largest producers of Bitcoin mining rigs. And so again, you don't have to have direct Bitcoin exposure. They actually do have some mining operations as well. So they also accumulate on their balance sheet. But a company like Bitdeer would also generate revenue by selling mining equipment to other companies that want to produce Bitcoin.
So, and that's one of those growing areas. Again, as mining operations continue to be more highly centralized, because there is a cost, as we talked about last week, to mining Bitcoin. And when you have economies of scale, that cost comes down. Energy cost comes down because you buy that energy in bulk. And so you're able to mine that Bitcoin in a more efficient fashion. So that benefits companies like Mara that have big industrial mining operations and can do it at scale. Again, I'm going to go back to that analogy where you may have other companies that do mining as part of their operation, or individuals that maybe do mining to try to acquire Bitcoin. And it's a lot more expensive to go out and pan for digital gold than it is to use a 30-ton excavator and dig big bucketfuls of digital gold out and run it through a processing plant, right? So, again, that operational size is an important consideration when thinking about the companies that maybe an investor puts into a portfolio. So some of these companies, we'll look at the individual charts here in just a second, but I wanted to ask, actually, we had a couple of questions while I'm pulling up the chart here and getting this set up. Jim, I want to bring in one of the questions that one of our longtime viewers has asked, and we'll talk about it just kind of in general terms because we'll talk more about it next week. But Josh Pink asks, how do derivatives like Bitcoin futures, like options on those futures, like options on other types of Bitcoin exposure, how do those derivatives impact Bitcoin price? Are they wagging the dog, or is Bitcoin driving? And when we've got a finite supply, how do those derivatives change
Yeah, great question. So
that
this
price, the underlying?
this comes up pretty frequently, and one of the criticisms is that because there's a proliferation of things like futures and options, it doesn't really matter the idea that Bitcoin has this limited supply because you can always gain access through a derivative instrument. I would disagree with that, and so ultimately, what I've seen is that while these derivatives do exist and they can provide exposure to Bitcoin, they're ultimately beholden to what's happening in Bitcoin. And so I've found that they can enhance volatility in either direction. Right? If Bitcoin prices are rising, you might see a proliferation of buying in long futures contracts or Bitcoin call options, right? And that results in more pressure to the upside. But it tends to be more short term. And then again, when Bitcoin is falling, you see those same pressures to the downside. So I don't see it creating more of a structural synthetic supply of Bitcoin. I found it really just tends to magnify the moves in either directions.
And then when you have magnified moves in one direction or another, then what the tendency is perhaps for other funds and companies to form to perhaps hedge off some of those volatile moves in opposite directions, right? Much like you have with individual equities, where you'll have exchange traded funds, or you'll have derivatives or strategies that can be used to either trade inverse relationships or soften some of those blows or buffer out some of that volatility, correct?
Correct. And I mean, there's an entire industry of crypto hedge funds that exist, and they're looking to kind of take advantage of this metric too, right? If they're seeing there's a lot of long interest, they might think of how they could maybe in a neutral way hedge this exposure so that they can maybe capture some arbitrage along the way. But typically for right every single long contract, there's an offsetting short contract, and so it does end up balancing
Sure.
itself out over time. But again, it does tend to be more of it adds to the short-term volatility. But the ultimate long-term demand really tends to still be driven from that limited supply of Bitcoin.
So, speaking of limited supply of Bitcoin, one of the questions that was asked was something like a strategy. What's the current state of strategy? And since they are a large holder of in this particular example Bitcoin, if something were to happen to strategy from a company standpoint, if they were to be delisted or there would be nefarious acts, what would be the adverse potential impact on the market? And so before I turn you loose with that question, Jim, I just want to point out we're looking at a 1 year daily chart of strategy. The purple line that I have on this particular chart represents the continuous contract of /BTC, which is the Bitcoin futures continuous contract. We're using that here as a proxy for Bitcoin spot. Now, we could display Bitcoin spot, but we don't have the same distance of history to show that information. Now, the line that I have down on the bottom is the correlation over a 10 period time frame between Bitcoin futures and the price of strategy. So you can see that it runs at a fairly high correlation. Correlation of 1 is a direct 1-to-1 correlation. A correlation of 0 is an neutral correlation, and if we were to go below 0, it's an inverse correlation in this display of information. So you can see most of the time, strategy runs at a just about a 1-to-1 correlation with Bitcoin, correct?
Correct. So again, strategy very correlated with Bitcoin. They hold over 800,000 Bitcoin on their balance sheet, and they're actually Great topic to bring up because they were in the news again today. Um, Related to the comment of what would happen with them could if the negative impacts, and so that's been kind of one of the fears in the past couple of months. Uh, Recently, within the past year or so, they started issuing preferred securities, and they did this as a means to acquire new Bitcoin. They issued 10% yielding preferreds, perpetual preferreds, which they would pay interest to investors, dollar interest to investors, high yield interest, and then they would take the proceeds from those preferreds and buy Bitcoin. So in the bull market, it puts pressure on Bitcoin prices to the upside because it pulls from the amount of available supply of Bitcoin for other investors. The fear is if something were to happen in the future and they had to unwind their total Bitcoin position, 800,000 Bitcoin, that could put a lot of selling pressure on the market. So that's been an area of kind of fear and concern in the markets. And the reason why I say it's timely today, they actually just raised about $300 million in cash last week, again, by issuing new shares. So this is a company that raises cash primarily two ways, through these preferred securities or common share issuances. And so they now have roughly 2 years of dividend coverage for their different preferreds. But as you raise more equity at lower multiples, it kind of reduces the ability to do that again in the future. The feature that most investors track for these companies is MNAV multiples. When a company trades at a premium to the net asset value of their Bitcoin, theoretically, they could issue shares and it's not dilutive to the shareholders in Bitcoin terms. As that multiple comes down, your ability to issue shares is then constrained. Again, so the fear is that if in the future these companies were delisted from different indexes, their multiples could compress. If their ability to pay these dividends over time continues to be at risk, they might have to sell their Bitcoin holdings. And again, so that's the fear that this 800,000 plus Bitcoin that they've had to strategically sell now in a couple tranches over the past couple months. If you could see cascading sales there and liquidations, it would put a lot of downward pressure on the broader market because it would just result in a lot of Bitcoin that had to be absorbed through the market.
Sure. And in the near term, what keeps this in close correlation is, at the very least, that arbitrage relationship where investors, institutional or otherwise, can buy and sell shares of Strategy and also buy and sell spot crypto or crypto derivatives in exchange in that arbitrage relationship. And that's what keeps them, much like an exchange traded fund, much like any other derivative, like a futures contract, is in line with its underlying representative instrument through that arbitrage relationship, right?
Yep, that's correct. It's ultimately high correlation to Bitcoin, and if they stray too far from each other, you would typically kind of sell short Strategy, not a recommendation, and buy Bitcoin. Again, not a recommendation, just kind of illustrating how that trade happens. And so that's
Right.
one of the things that kind of keeps them close.
So let's go to the other one in that first tranche of stocks that we looked at, Galaxy, that has other products, other services, seeking to diversify their model a little bit. And we'll take a look at the correlation here, and you can see that again, purple line, same setup, same technical indicators here on the chart. Correlation on the bottom. Purple line is the /BTC cryptocurrency or Bitcoin futures. And you can see that, in fact, over the course of the last little while, Galaxy has started to separate and go and kind of diverge somewhat from the movement of Bitcoin as a pure play. And there's been this somewhat inverse correlation between the two.
A lot of this can be attributed to Galaxy focusing on AI data centers. They were traditionally viewed as a crypto infrastructure company, and now they're pivoting and they're referring to themselves as a digital infrastructure company. They can be infrastructure for all types of digital economies, right? So right now they're in the process of building out data centers do AI inference for different AI data centers. And again, so they're seeing more of some price action related to that. If you look at the economics of mining Bitcoin compared to the economics of high performance computing, per megawatt hour, it's much more profitable to be on the AI side. The caveat is there's inference contracts that need to be rewarded there. There's other competitors. And so we don't foresee this being the type of thing where they completely exit the mining and Bitcoin infrastructure side of things. But ultimately, they are trying to diversify their revenue streams to something that's not just Bitcoin sensitive.
So now I'm going to bring in a chart of Tesla, which arguably has lots of other business models, but in their digital treasury, they hold lots of Bitcoin and lots of other, I'm sure, in this case, cryptocurrency examples. And so you see, again, a decreasing correlation between the two, but there is still an influence because that influences their the value of the storehouse that they have, right?
Yeah, look, it goes down to a few things. And so ultimately, Bitcoin and Tesla are completely different things. Tesla is a company that exists primarily to produce electric vehicles. They do hold some
Yep.
Bitcoin on their balance sheet, but they're a risk asset. Now, Bitcoin is a monetary asset. It exists as a store of value and a currency. And so its only purpose is the purpose that people subscribe in it, if it's something to store or it's something to transact with. Now, the correlation exists because one, they're both high growth assets, and they're also both risk assets. And so over time, they can have periods where their correlations rise. Now, Tesla, being that they also hold Bitcoin on their balance sheet, you do see a bit of a higher correlation because higher Bitcoin prices would be a net positive for Tesla shareholders. The net asset value of their Tesla stock would be higher because they have a higher valued asset on their balance sheet. And so it's natural to see some correlation there at times, but ultimately they're fundamentally very different. And so if you're the type of investor and you want exposure to Bitcoin, Tesla wouldn't necessarily be your first choice. But if you were the type of investor that wanted exposure to maybe a growthy car company that also had exposure to Bitcoin, right, then it makes a bit more sense. But it's important to understand that they're fundamentally different things. And while yes, they are correlated and Tesla can benefit from it, the primary purpose of Tesla is not to acquire Bitcoin.
Sure. And I suppose the analog here would be also the idea of a company that had a huge cash US dollar stockpile on their balance sheet of free cash that they could use to invest in CapEx and everything else. And that value of that storehouse, of that treasure chest, if you will, would go up or down based on the changes in value of the US dollar, right? Very similar analog to what we're talking about here.
100% exactly.
Yeah. So, Jim, before we go, and I know we're running short on time here as we get into this, I just want to talk about kind of a larger kind of meta discussion, and that is some of the reasons why. And again, this is not advice. This is just simply discussing this in a kind of overarching topic. But what are some of the reasons why investors maybe would consider holding cryptocurrencies as an investment as part of a larger portfolio?
Yeah, there's really a couple of use cases that we think about. So first, right, goes back to why Bitcoin was created when it was created. It was born in the depths of the financial crisis as a decentralized payments network with its own currency. It had impacted by central banks, central authorities. No one controlled it. And so the primary use case a lot of investors see Bitcoin as, they treat it as a digital gold. And it's different than gold, but the comparison is that it's a supply constrained asset that people see value in. And so from that context, people can think about it as similar to a gold exposure. Now, the caveat is gold is typically seen as a risk off type trade, right? And if you think maybe the market's going to crash or geopolitics are ramping up, gold might rally. Bitcoin is a risk asset. But outside of that, again, it's kind of this store of value that operates outside of traditional financial networks. And so that's one use case where people might consider it. The second, as a technology investment, fundamentally, blockchains are technology. So some investors who are interested in having technology exposure, they might be interested in having exposure to cryptocurrencies because it's quite literally a play on their underlying blockchain. If they think blockchain technology is going to continue to be adopted by financial institutions or people around the world, that could create more demand for the native cryptocurrencies. And so those investors might actually be more interested in something like Ether or the blockchain issued by a smart contract platform like Ethereum or Solana. And then finally, you have asset allocators. So fundamentally, over the long term, Bitcoin specifically has a low correlation to other asset classes. On a 4-year time frame, it has about a 0.3 correlation to US stocks. It has a very low correlation to the dollar, interest rates, gold, oil, you name it. And so while it's a risk asset, still those who want to have their portfolio really driven by aspects of modern portfolio theory, they might want to have a position in Bitcoin because it is a growth asset over time. It's continued to grow even though it's volatile. And so again, they might have that asset allocator perspective and want that exposure there. And so those are really the three primary use cases we've found that investors are interested in adding crypto as an investment to their portfolio. And then finally, you have the traders out there. Why do traders like them? Aside from these three aspects, they're volatile. If traders want to do any type of short-term trading, arbitrage trading, right, use that volatility to your advantage, there's definitely no shortage of volatility to go around. So that's kind of the fourth use case there.
Excellent. So, Jim, now as we're kind of wrapping this up in this discussion, and we're going to get a lot deeper into this discussion next week when we talk about what impacts cryptocurrency prices. And I'm really kind of excited about that discussion because there's some things that we want to kind of dig a little bit deeper into this week than we have in past iterations of this webcast, with some new data that we are getting from Schwab Center for Financial Research and elsewhere. But I wanted to talk about where our attendees could go to find more information. So I wanted to bring that up here. Greatest place to do that, youtube.com/Trader Talks Webcasts. And just type in the word cryptocurrency into the search bar and you can see our entire playlist for this particular webcast. But we also have webcasts like the Trading Futures webcast that I teach on Tuesday mornings, where we talk about and show illustrative educational examples, not recommendations, of futures and cryptocurrency futures trades, so that those are illustrated within that particular context. So you've also got, I know, Jim, you've done a great job in putting together some short videos and talking about some of these specific aspects of cryptocurrency and kind of breaking things down. But two things. One, we've got a feedback survey out in the chat. So do me a favor, fill out that feedback survey if you wouldn't mind. Two, click on the subscribe button if you have not done so already. And then before we go, Jim, I'm going to give them an opportunity, or give you an opportunity, to share where attendees could find more of the great information that you put out on a regular basis regarding this particular topic, because you are all over the place with this.
Yeah, you can follow me on X or Twitter, whatever you want to call it, at Jim Ferrioli. You can also check out anything we've published on schwab.com/learn. We have an entire page dedicated to cryptocurrency insights. Those are the two big ones. We're also frequently on the Schwab network, so feel free to log on 24/7 streaming and hear the latest on what we're thinking in crypto markets.
Awesome. Jim, thank you very much. My friend Jim Ferrioli from Schwab Center for Financial Research, our director of cryptocurrency trading and strategy. My thanks to Kevin Horner for helping out. My thanks to all of you for being here with us, and our great production staff and reviewers for helping to bring this information to you. We will see you again next Monday for session 4 in this 4-part series. How do cryptocurrency prices move? So we will see you then. Thanks, Jim. Take care. Have a great week. See you, everybody.